All right, welcome everyone. Thank you for joining Mayor Brown's Joint Venture and Strategic Alliances practice for the latest installment of our informational webinar series. My name is Reb Wheeler and I'm delighted to participate with my partners in today's presentation. Our practice comprises attorneys from across our global platform and our varied practice areas who work together to provide the interdisciplinary support our clients need in these often complex transactions. Our team is experienced in supporting joint ventures and strategic alliances involving parties and assets around the world, from their inception through their growth and development, and ultimately in connection with exit and monetization transactions. Our presentation today will focus on joint ventures in Brazil, including the current structures we're seeing in the market, some of the local regulatory and tax considerations, and we'll offer some advice for parties thinking about establishing JVs that touch Brazil. We'll be conducting webinars covering additional topics related to joint ventures and strategic alliances throughout the year, and hope that you'll be able to join us for those upcoming events. You can also find many of our past programs on our website, www.mayorbrown.com. Now, we just need to cover a couple of administrative matters and then we'll get started. This webinar is being recorded. In a day or so, we'll be sending you an email with a link which you can use to listen to the presentation again or share it with your colleagues. Also, for those obtaining CLE credit for this program, we will announce the event code in the middle and again at the end of the program. If you have a question, please type it in the chat section of the WebEx login. We'll try to answer questions at the end of the program, time permitting. Otherwise, we'll follow up with you after the presentation. Okay, with those items out of the way, I'm pleased to introduce today's presenters. Joining us today are Guilherme Vieira da Silva and Thais Rodrigues of Mayor Brown Twill & Checker's Rio de Janeiro office. Guilherme and Thais regularly advise clients on a wide range of corporate and tax issues that arise in connection with joint ventures in Brazil. So with that brief introduction, I'd like to turn the call over to Guilherme now to begin the presentation. Guilherme?
Well, thanks a lot, Reb. Well, good morning, good afternoon, or good night, depending on which part of the world you're located. This is one of the wonders of the technology that we might be able to conduct this webinar. As Reb just mentioned, my name is Guilherme Vieira. I'm a corporate M&A partner with Mayor Brown in Brazil, and this is my voice. I'm joined here with Thais that would take the hard work of commenting taxes implications in Brazil associated with JVs, joint ventures in Brazil. And I want to start off by telling a story and asking you to picture in your mind the Amazon forest, okay? I want you to picture the forest and its gigantic size. Miles and miles of forest without any noticeable signs of civilization. That forest holds a sizable reserve of bauxite, a mineral that can be transformed into aluminum. But establishing a plant in that forest that could produce aluminum from that bauxite is a gigantic project. First, it requires a source of power and energy for the plant's boilers, which is inexistent. Second, it requires a line of transmission, which is also inexistent. Third, it requires infrastructure means to transport the products out of the plant and to the final consumer, which is also inexistent. And it requires lodging for the workers of that plant. All that to produce a product which price is very volatile in the international market, and the economic efficiency may change from day to night to determine the success of that project. Nevertheless, that project came into life and became outright in Alunorte, a JV joint venture between the Brazilian mining company Vale and the Japanese Nalco, which occurred in the mid-'80s. It resulted in the construction of a power plant, a real city to receive the workers, and also in the construction of ports by the river to make the transportation of the products to the final consumer. I really like that story because it represents well what a joint venture should be. It involves risks the magnitude of the project is it's very large, and it also involves the potential for high gains and high losses. I really do not want to engage in a deep discussion at this point of the nature and logic of a joint venture, as I think a large part of all the participants here already has already initiated in the subject. But I do want to throw out the distinction that I find important to make sure we are on the same page on the topics that we're going to discuss here forward. I like to think of a joint venture, I like to define the joint venture more by what a joint venture is not, rather but what they are. I like to view the joint venture as not being a gathering of cash and funds from investors dedicated to a particular line of business. Instead, I would like to view it as a gathering of expertise from various sources of bodies channeled to a particular project. Evidently, most of the time, investments in cash will be necessary, but what is fundamental is the character and the personal identification between the participants of a JV and what each would contribute to the success of a given project. As in the Outdraws example, what seems to drive participants to a formation of a JV is the prospect of a project that, for its characteristics, poses many challenges. And through the combinations of forces with other participants, those challenges may be overcome through the experience of the participants. Evidently, these projects tend to be highly dependent on cash and involve a high level of risk, right? And let's be honest, now, a corporate decision to explore a new market in a different jurisdiction can be very disturbing, and companies considering this movement have tons of questions to get to a point of being comfortable in entering a new market. And dominating the navigation of the Brazilian business environment may be very challenging for someone from a different culture, perspective, or expectations. That's why we think that teaming up with a local partner to enter the Brazilian market, especially from someone coming from another jurisdiction, is such a common solution for their hurdle. Us as M&A lawyers and holding constant contact with bankers and financial advisors, we hold a privileged seat in overseeing how these participants tend to organize. And you know, in our experience, we notice that on one hand, there's always that entrant that's very aggressive and has an approach to be confident to easily dominate the local environment. But on the other hand, we see that there are more conservative participants that tend to take a step back before entering and posing the question, oh, all right, let's try to see if there's anyone here who we might team up and that could provide us a support and try to navigate in that market. And the most successful initiatives were questionably those that sought a local partner to team up with. Of course, you can reach that same type of comfort through acquisitions, which would provide you with a team of managers, local managers that can help you navigate in the local market. But when you scale up the size of project, when you scale up the risks, when you scale up the fact that you are entering into a new type of business, JVs are usually the choice. Usually, the combination of two participants is sufficient and the preferred form of organization, and we see that a lot. These JVs formed by two players only, it's very, very common in the automotive industry and in the agricultural industry. In the automotive industry is common not only in Brazil but anywhere else in the world. But in Brazil, we'll have a very recent example of the Chinese manufactured cherry coupling up with Caoa, which is a Brazilian manufacturer of cars. And we have all other examples like Auto Latina, which was a JV between Volkswagen and Ford in the late 80s and early 90s. More common joint ventures between multiple parties are in the oil and gas and in the construction business. We're going to talk about a lot about the oil and gas and the construction business, but it is very common there. It's rarely we see any JV where there are only two parties involved to pursue a business in those industries. But what is important for us as lawyers, at least for me here, is the form that these joint ventures can take to organize themselves and establish in Brazil. That's because joint ventures can be materialized into the world, and this is a very important point here, by a simple contract, mostly establishing cooperation between two or more companies. And these types of contracts are commonly referred to as non-corporate JVs. More commonly, though, the JV can be materialized through the creation of a corporate entity that will work as a means for the JV to operate. These are the so-called corporate JVs. While there's not a specific rule for the formation and organization of a joint venture, participants may freely regulate the functioning of either a non-corporate JV or a corporate JV by means of contracts. And with these two classes of JVs, namely the non-corporate and the corporate, participants may resort to several types of corporate formats to make the JV, the joint venture, comes to life. And I will try to address them separately. Now, a first type that I want to discuss here is the consortiums. There are certain things that only exist in Brazil. I don't know if you ever heard about the fruit jabuticaba. That's an example of a fruit that only exists in Brazil. Another example is the consortium. While they're in other jurisdictions, you also have an organization with the same type of name. Here, what we call the consortiums is a completely unique type of partnership. The consortium is a type of unincorporated type of entity, meaning that it holds no corporate veil and may be viewed as a type of a non-corporate JV. It is regulated by law 6404, which is the corporations law. That law is almost exclusively about the organization of a corporation that we are gonna talk about, but also addresses a consortium. While it does not hold a corporate veil, it is registered with the Commercial Board of Trade, which is something typical of corporate entities, and it enrolls with tax authorities and receives a federal taxpayer number. This is just an example of how far tax authorities can go to make sure that everyone pays their taxes, because it would be absolutely inconceivable. It would not make sense in an organization a tax organization to have that number for unincorporated entity. And one comment that I need to make also about the consortium is that 40 years ago, when the Bill of Law that created the corporations law, 6404, was submitted to Congress for approval, it went along with something that we call the justification for why that Bill of Law is being proposed. And the topic that dealt with the consortiums had the following, I quote unquote, "It is justified as to complete the many associative forms of partnerships that the Bill of Law regulates, And regulating the consortium is a modality of a non-corporate partnership that has the purpose to carry forward a predetermined venture. Now, if that sounds to you as a description of a non-corporate JV, that's because it is. However, there are certain peculiarities about the consortiums that we need to tackle to distinguish between the consortiums and other forms of non-corporate JVs. In the consortiums, the contract that creates the consortium must necessarily be filed with the commercial board, and it must provide that each participant's obligation in consortiums are made without any assumptions of joint liability. But there's an exception to that. If the consortium is created and wishes to participate in public contracts and public bids, another law, the public bid law, establishes that the participants of that consortium must expressly provide that they are jointly liable for the consortium's obligations. Other rules must also be provided in the consortium contract, such as the booking of the revenues and expenses, decision-making rules, and each participant shares in the consortium. Now, there's a very important point that it somehow tackles a tax aspect that Thais is going to mention later on, but we need to take in consideration that when you have a law that expressly recognizes and regulates a type of a contractual arrangement, you are also directly recognizing that there will be interactions between the participants of that consortium. So if you take, for instance, an example of a consortium created to take part in a large project, you would anticipate that the leading participants will need to engage in contracting suppliers and engage in several types of obligations. And the non-corporate contract will have, and usually does, provide for forms that one party can obtain reimbursement, and how the various parties to that JV will interact and make circulate funds among them. If you're not organized as a consortium, there's a strong likelihood that tax authorities can view that arrangement of reimbursing one party and another as revenues, and by considering that as revenue, you may be taxed accordingly. Now, if you have a consortium organized under the laws of the corporation law, you would not have that risk. So this is an important aspect of why you would prefer this sort of a non-corporate associative joint venture rather than just a simple plain contract between the parties not taken to a registration. Silent partnerships. Silent partnerships, or also called in Portuguese, sociedade em conta de participação, are another type of unincorporated and unregistered type of partnership that could be used as a means to make the joint venture concrete. This is an associative type of partnership form regulated by the Brazilian Code. The Brazilian Code treats the silent partnership as a simple contract, and it really is, in a sense, a simple contract between silent partners who will only contribute capital to the partnership, and the ostensible partner who will perform all actions under its own name and liability to benefit the partnership, but will share the profits with the silent partner. The main difference between silent partnership and the consortium is that the consortium, the corporate documents are made public upon registration with the commercial board, whereas the silent partnership agreement may remain in each participant's drawers for an eternity, and no one will gain knowledge of the existence of that partnership. Also, in case of bankruptcy of the ostensible partner, the silent partnership is terminated automatically, whereas in the consortium that's not true. Another key distinction relates to the form of assessing the results of the joint venture. In the consortium, each participant will book and recognize its contribution and results to the consortium according to their participation. Whereas in the silent partnership, there will be a separate tax accounting exclusively for the partnership, albeit not unincorporated nor a corporate JV. So in other words, you would, while you only have a contract established between the parties, you would have to make a separate accounting as if that contract was a different entity. And interactions of services and contributions between the partners could also be viewed as services between the partners as in the other non-corporate JVs. I want to talk about now the corporations. The so-called Sociedade Anônimas are the equivalent to it's usually described as the equivalent of a corporation in the USA. As opposed to consortiums and silent partnership, they are a form of incorporated and registered company. They are perhaps the most common type of corporate entity for a corporate JV. And there's a really good reason for that. You see, the law that regulates the functioning of a Sociedade Anônima, the corporations, dates back from 1976. It's the same law that regulates the consortium. And it is, until these days, considered a very, very good law that crafted a very flexible type of entity with several tools that one can make use of, which are not present in the other forms of companies. For instance, a corporation can issue securities and bonds, which can be a useful tool to finance a joint venture. It can also issue non-voting preferred shares. You know, there was a case that I worked many years ago now, where there was a JV in the telecom industry, organized as a corporation that was undergoing financial distress. And we put together a financial plan for the sale of the company's control, followed by a material capital injection by the new controlling entity. There was a problem, though. The company needed immediate cash, and the transfer of control of the telecom company was subject to the National Telecommunication Agency prior approval, which could take months. So what we did was we made use of issuance of non-voting preferred shares that was subscribed by what came to be the controlling shareholder after the agency's approval. But at the time, we made use of a non-voting shares that was subscribed by this purchaser that at the time injected capital of the company, not gaining control. But once the agency approved the change of control, those non-voting preferred shares were converted into common voting shares. So that's an example of how valuable that tool can be in the day-to-day business of corporations. Another notable, very important characteristic of a corporation is that it is subject to the majority rule of decision taking. We highlight this point because the limited liability company that we will talk about in a minute, the majority rule is not applicable it's applicable only to certain matters. Critical decisions, however, are subject to a quorum of 75% of the corporate capital. What this really means is that in a limited liability company in Brazil, one can only have absolute control with 75% of the capital, whereas in a corporation, control is achieved with the majority of the voting stock. Also, a characteristic available to the corporation is that the law expressly provides for the role of the shareholders' agreement as an instrument of governance of the corporation. In fact, the corporation's law provides that the board of directors and the board of officers must comply with its terms, and any vote casted in offense to the provisions of the shareholders' agreement should be disregarded. That means that the shareholders' agreement of a corporation is self-enforceable. It would not be necessary to engage, to file a claim or engage in a lawsuit to make the provisions of the shareholders valid, as managers have the duty to know the content of the shareholders' agreement and apply it on the day-to-day business of the company. One downside of the corporations in comparison with the limited liability companies has always been the cost associated with preparing and publishing financial statements. But this is no longer a disadvantage of the corporations against the limited liability companies. You will think that I would say that this is no longer a requirement, but in fact, it became also a requirement to the limited liability companies to prepare and publish financial statements if certain thresholds are met. And those thresholds are at least 300 million reais in revenues and total assets in excess of 240 million reais. If limited liability companies reach those thresholds, prepare of the financial statements and publishing would be mandatory. And in our experience, JVs organized under those forms usually meet those thresholds. Now, limited liability companies, or limitadas, as we call it, as the name suggests, limited liability companies provide for a limited liability of the partners up to the amount of the capital contributed to the company. And it is regulated by the Brazilian Code. Brazilian Civil Code is, as in the silent partnership, it is also. And until 2002, when the quote-unquote new Brazilian Civil Code was enacted, the limited liability company was regulated by a law that only had 13 articles, and it worked wonderfully. However, the Civil Code added a series of what I can only call schizophrenic rules to regulate the limitadas. For instance, the requirement for 75% of the capital to change the articles of organization was inserted. It might not seem much, but it is in the articles that the managers are appointed. So you would need, in practice, 75% of the capital to appoint a manager. But the same law established that you would only need 2/3 of the capital to terminate or terminate a manager from its position. So you would need a smaller portion of the capital to terminate a manager, but you could not appoint a new one unless you have 75%, which I don't know about you, but to me, it doesn't make any sense at all. I don't want to spend too much time on the various examples of strange rules applicable to limited liability companies, but that illustrates some of the difficulties one may hold in having a corporate JV organized under such format. Another curious aspect of the limited liability is that, and it's really interesting because there's a long-standing debate around this subject, is that limited liability companies cannot issue stock, of course, because the capital is divided in quotas. But there was never a good reason why limitadas, limited liability companies, could not issue bonds or debentures. In fact, this has always been a point of many comments and discussion that it's always brought out by a lot of many lawyers and scholars. Nothing should prevent limitadas to issue debentures, but the fact of the matter is that the Brazilian Securities and Exchange Commission has issued formal statements in that regard, and so did the Commercial Board in Brazil. preventing limitadas to issue debentures. Rep, you may correct me if I need to mention anything else with this.
That's right, Guilherme. Thanks.
All right. Now, challenges, and this is the fun part for us, that we face in organizing, in working this type of projects. So every time that we got involved or engaged by a client in a project to form a joint venture, 7 out of 10 times those cases, the clients are imagining a 50-50 type of joint venture. In those other three cases, they're usually considering a multi-party type of joint venture, usually in the oil and gas and construction side. But I never get a call of someone trying to say, hey, listen, Guilherme, I'm considering a joint venture where we're going to hold 51%, and someone else is going to hold 49%. This is rarely the case that we get a call like that. But in any event, it leaves us with a fun field to work on. But it's a tough field to work on. The reason is that the decisions on a 50-50 type of joint venture will have to be taken by consensus between the parties. And there's really no perfect solution in case of a deadlock occurring to decide on certain matters. We usually try to recommend that someone in the joint venture must have the final decision on certain matters. But we understand that's not usually the case, and things scale naturally for a format that the consensus will be required. And usually alternatives available that we make use to address a possible deadlock, it's a combination of several mechanisms established either in the bylaws or in the JV agreement or in the shareholders agreement. If a given matter is proposed, say for instance, to approve a budget for the upcoming fiscal year by one party and vetoed by another, that who vetoed must propose an alternative to the matter suggested. The problem is that not always decisions are around matters that could have alternative versions to it. If you take, for instance, a decision about selling or not a given division of the joint venture, the matter would have to be decided either a yes or no. There's no, you cannot create a variation around that theme. And in those cases, when common grounds are not reached, we need to propose a mechanism to escalate the discussions to the parent company CEOs. The idea here is really that more senior executives can reach an agreement where people in the level of the joint venture cannot reach. And if that fails too, then we can make use of the buyer sells and put calls and the term of the art shotgun clauses as a mean to unwind that deadlock. And the way this usually works is that who proposes a matter that was vetoed may have the right to trigger a buy or sell of the participation in the joint venture. And that participant offers to buy the shares of the other participant at a specific price per share. That other participant must then either accept the offer or sell the participation to the person triggering the clause, or buy the participation from the triggering participant at the same price per share. This is also a solution that involves a great level of strategy and a very high level of gambling too. And it favors the party holding the strongest financial position, right? Many years ago, I helped a client structure an alternative for this dilemma, which I find very interesting, but that I wanted to share here. The client was a top-ranked Fortune multinational American company that was entering Brazil and teaming up with another very large Brazilian company. And because of the characteristics of the joint venture that they were forming, my client's role was really focused on one segment of the business, while the Brazilian company was focused on another. So what we did was that allowed us to create two different entities that was focused on the segment that my client was the expert. In that company, my client had the control. And another company mirroring that same entity was created, and the Brazilian company that they were teaming up with had the majority of the shares of the voting shares, and therefore held the control because they could be the expert on that segment of the business. I do understand that this is that was possible, and in other circumstances was possible too, because the business could receive that type of arrangement, but it's not always the case that we can make use of that arrangement. I want to talk about a little bit of corporate governance, which is a very sensitive issue too, because in those 50-50 types of joint ventures, there's also always a discussion of who gets to appoint the CEO, who gets to appoint the CFO, and there's all types of Solomonic of alternatives to address that dilemma. There are alternatives where during 2 fiscal years, one party appoints the CEO and the other the CFO, and after the lapse of that 2 years, that is changed. But that can be disruptive to the business of the company, and because you will have to change who's the CEO and who's the CFO. What we usually suggest is let's make the CEO and the CFO not organized within the company on any form of hierarchy among them, but let's make all of the officers subject to either the shareholders meeting or the board of directors. So they will have to show their accounts and pay their dues to a higher level corporate body rather than have some sort of subordination among themselves. Another important topic that arises constantly are the matters related to conflict of interest. You know, given the nature of the JV that may require the performance of the participants of certain actions and services, that the conflict of interest can really easily arise very commonly. We worked on a case where one of the participants was hired by the JV to construct and deliver parts of a plant that needed to be delivered to the JV. You see, they formed a joint venture that contracted one of the shareholders of that joint venture to produce parts for the construction of a plant. So it happened that that party delayed considerably, materially, the delivery of those parts, which created a lot of damage to the joint venture. And so it happened also that the contract established a very high fine to that participant. But at the same time, the corporate documents of the joint venture established that to impose that fine or to terminate the contract, it was necessary for the matter to be voted by the shareholders. And once that matter was taken to the shareholder meeting, of course, that shareholder who was responsible for the delay vetoed the termination of the contract and the imposition of the fine. So to avoid that type of conflict, we suggest that in the bylaws or in the shareholder agreement, the rules for the conflict of interest must be really clearly laid out. And you need to establish, and this is a very important point, you need to establish that the party in conflict should be prevented from voting in that shareholders meeting. because if you rely on the Brazilian law, you might have to live with a circumstance where the conflicted party would vote first, and you would discuss later whether or not that vote was casted in conflict. Non-compete obligations. What we need to highlight here is that non-compete obligations are perfectly valid and enforceable in Brazil. But there's one element that, albeit obvious to some extent, it is worth mentioning, that you need to establish a non-compete including during the period when the joint venture is in effect. This is to avoid that you form a joint venture with one party and that same party establish a new line of business that would compete with that joint venture, at the same time having privileged information about the business. And another point worth of note is that if you want to impose a non-compete to officers or members of the board or individuals, you need to be sure and make sure that those individuals are being compensated for the obligation of not competing with the company. That's because a professional under the laws of Brazil cannot be prevented from exercising his profession unless there's some sort of consideration involved. I'll start to hurry up a little bit to leave some space for Thais, who's anxious to jump in here, is raising her arm. Anti-bribery and FCPA. This has come into fashion. It is an important point. What the word of the hour is that you need really to carry a thorough due diligence on whoever you choose to team up with. Due diligence, and also make sure to have in place a strict and clear anti-bribery policy that needs to be followed constantly. With respect to liabilities associated with joint ventures, we have the large ones that people usually focus. Environmental, which is the key one, and regardless of the form that you choose to set up your joint venture, the participants would very likely always have their skin on the game with respect to environmental liabilities caused by the joint venture. We have the example of Samarco recently that is a joint venture between Vale and BHP. Both are being held liable as well for environmental damages. Labor and tax are, albeit also an important point that can escalate to the partners, should be dealt with a lot of concern. Make sure that you comply with all those laws because you may not be restricted to the level of the joint venture. It may escalate to the partners. So real quick here, there are certain industries and certain segments of the Brazilian market that you would have restrictions for foreigners to take part in. You know, one line of business would be any market that involves rural lands in Brazil. You know, that impairs the mining industry, agricultural industry, timber industry. You know, on itself, this topic could be a subject for one single webinar that I'll be happy to talk about because it's a very interesting topic. But there's for some years now, there's an opinion in place that prevents or reinterprets the Brazilian law as imposing restrictions for foreigners or Brazilian companies controlled by foreigners to hold title or lease rural lands in Brazil. And albeit that restriction is in place, we resort to many alternatives to address that restriction that we usually investigate on a case-by-case matter. On the oil and gas industry, I have heated discussions here with my partners. 100% of the joint ventures that are formed to take part in public bids in Brazil are organized under the form of consortiums. But if you look at the law and the code word of the law, nothing prevents you from organizing as well yourself as a corporation. And I think, to my eyes, the corporation would be a more suited type of entity to participate in those bids because it provides a lower level of joint liability between the participants.
Hey, Guilherme, we have about 10 minutes remaining, so it might be a good time to pivot to the tax issues.
I was about to do that, Reb, because the other topics we already tackled. So with that being said, I'll pass the word to Thais.
So hello, my name is Thais Rodrigues, and I'm a senior tax associate here in the Brazilian office. As Guilherme mentioned, I'm here to talk about this exciting subject, which is tax in Brazil. I will try to be fast and take these 10 minutes just to discuss some of the tax aspects and some issues that may arise from signing JVs in Brazil. Guilherme has already mentioned some of these issues, but I would like just to highlight the one that could have the worst outcome from a tax perspective, which is using or to form a JV without using any of the foreseen legal structures. This is because, as he mentioned, when you have a JV without using any legal structure, what happens is that tax authorities will view all the transactions between the participants of the JV as a taxable transaction. So usually what happens is that revenues between the coming from the JV, contributions to the JV, and also any funds to the JV will be viewed as a taxable, will be likely be subject to taxes. We can say that the risk of challenges from tax authorities is significantly reduced if one of the mentioned legal structures is used, even though, as you may be aware of, in Brazil we can never fully disregard the change of a tax assessment. Nevertheless, Brazilian legislation has dealt with consortiums and the silent partnership. They have specific tax rules for that. So using one of these non-corporate JV structures reduce the risk of challenge from tax authorities. In fact, what we notice is since from the addition of tax rules that must be followed by consortiums, challenge from tax authorities have been drastically reduced. Brazilian IRS has even issued advanced tax rulings in favor of taxpayers to affirm that reimbursements carried out between the members of the consortium should not be treated as taxable revenue, which is very important when you are dealing with, for example, oil and gas activities, in which consortium arrangements are usually the adopted structure, and the amounts subject to cash calls are very material. So just to talk a little bit about the aspects of the consortium, the tax aspects, as Guilherme mentioned, they should be enrolled with the so-called CNPJ, it's the Federal Tax Registration Number. Even though they are subject to disenrollment, they are not deemed as legal entity for tax purpose, and for that reason, they are not liable for any taxes. The members of the consortium are liable for taxes in the proportion of their participation. However, they may become jointly liable for taxes in two different situations. First, if the leader of the consortium acts under its own name, but on behalf of the other members, the members become jointly liable for taxes. The other situation where joint liability may arise is when the consortium contracts third parties under its own name using the consortium tax ID. Other aspect that should be observed is that even though they are not deemed as legal entity, as from 2010, consortium are allowed to issue invoices and also to contract legal parties. In these cases, if they, besides the members become joint liable for taxes, the consortium should file the relevant tax returns and should also pay certain withholding income tax that may be due because of the contract of third parties. In any case, revenues, costs, and expenses related to the consortium's activities shall be recognized and taxed by each member on the proportion of their participation, which means that they will subject any revenues, tax, and expenses to their own tax methodology. Regarding accounting records, the leader shall provide all information to the other members, and the leader and the members shall keep separate accounting records for the consortium's activities. Another important issue that may arise from the consortium is how to treat revenues distributed to and funds contributed for when a member of the consortium is domiciled overseas. Although the general rule should apply, and for that reason, revenues should be taxed only by the member domiciled overseas in their own jurisdiction, tax legislation determines that revenue should be subject to the withholding income tax as if a service is imported from this international member, which is a problem and increases the tax burden for the international party. Okay? No. So, silent partnership. As mentioned by Guilherme, silent partnerships are non-corporate entities, but tax legislation treats them as a legal entity for all tax purposes. So, in addition to that, since 2016, the silent partnerships had to be enrolled with the tax ID, which makes no sense because they should be silent and unregistered entities. Well, as a legal entity, the silent partnership pays taxes as any other legal entity, but the ostensible partner is required to collect and to file all tax returns on behalf of the silent partnership. And only the ostensible partner is liable for taxes and for the filing of the returns. Silent partnerships can distribute dividends to their participants, and these dividends are exempted. On the other hand, any taxable losses accrued by the silent partnership cannot be offset with partners' taxable income. They are allowed to elect any type of methodology for calculating and pay taxes, even if it's different from their partners. But election should observe the general rules applied to any legal entity. Another important aspect of the silent partnership is that the disposal of the investments by either the silent and the ostensible partner are subject to the taxes of, you'll be taxed at capital gains or losses as in any other disposal of investments. Well, corporations and limited liability companies, they are deemed as legal entities for all tax purposes, and they are actually legal entities. There is virtually no difference between the tax rules applicable to any of these type of entities, so they can elect to any methodology for the taxation of their income tax. The dividends are not taxable or exempted. They can remunerate their partners. They are subjected to any and all tax rules as any other legal entity. So I think I will not go into the details of that because it's the general rules.
Okay, so we are right about past the time. Reb, I think that if the audience have any questions, we'll be glad to address them. Evidently, if anyone wishes to email us and have any discussions with any of these topics, we'll be glad to do it.
Yeah, I think that's right, Guilherme. If anyone has questions, please feel free to contact Guilherme or Thais. Their contact information was in the invitation you received for the webinar. Other than that, we'd like to thank everyone for their attendance today. And as I noted at the outset of our call, we'll be sending out a link to today's presentation. And as Guilherme said, if you have questions, please reach out to either he or Thais. We look forward to having you participate in future programs presented by our Joint Ventures and Strategic Alliances program. Thanks very much. Bye-bye.